Good evening, VectorVest Nation. Ron Wheeler here, the manager of options trading at VectorVest, and it's my delight to bring you tonight's special presentation. 5 weeks ago, we took a group of people, many of whom had never placed an option trade before, and we showed them how to create a simple trading strategy that was low risk, designed for income. This means that you can make money even if our market direction is wrong. It only takes 5 minutes. And over those 5 weeks, we had 5 winning trades. And those 5 winners gave a 17% profit or a 17% return in their accounts. So let's take a look at how we did it. First off, we trade the S&P 500. And every Monday morning, we place a trade. And we do it based on market timing. So we placed our first trade on September 27th. The following Monday, October 4th, we placed another trade. On October 11th, we placed a trade. On Monday, October 18th, we placed a trade. And then our last challenge trade was October 25th. So I'm going to go into these trades in detail and show you how they worked, what the process was, and then also what the result was over the course of this presentation. Now, keep in mind, we're doing this using a $5,000 trading account. So if you have a $50,000 trading account that you'd like to try this with, take the profits I'm about to show you, multiply them by 10. If you have $10,000, take the profits I'm showing you, multiply them by 2. So our first trade kicked off on Monday, September 27th. The market was bearish at the time, so we placed a bearish trade. And you can see I took a little snippet from my Thinkorswim trading account, and you can see that we entered the trade on September 27th at 9:40 in the morning, and we were out of that trade the following day around 10:08. And that trade resulted in a $190 profit. Now remember, if you did this on 5 contracts, take that number by 5. 10 contracts, you make $1,900. It's $5,000 for every contract. Now, we shut down trading. We come back the following Monday, October 4th, and we place our next trade. This also happened to be a bearish trade. Now, this was a little unusual. We got into the trade at 9:40 in the morning. We were actually out 2 hours later for a $210 profit. That's not typical. Typically, these are 2 to 3 day trades designed for you to take one every single week. That's great. Trading is now done for the week. We move on to the following Monday, October 11th. We again trade the market in the market direction. We placed our trade around 9:40 in the morning. By the 2 days later on Wednesday, right around 9:50, we were out with $220 in profits. Now, the following week, you'll have to excuse me on this one. I don't have a screenshot because my colleague did the trade. We had a $115 gain in 2 days. That was the trade from October 18th. Now, the following week after that, I was back in the saddle, so I have my Thinkorswim account to show you. This was our trade from Monday the 25th, the one that was just this week. We entered the trade, again, right around 9:40 in the morning, but time doesn't really matter much. You can place these trades later in the day on Tuesdays, etc. We were out of that trade on the 28th, and we received a $115 profit. Over the course of those 5 trades, that was an $850 profit. So your $5,000 trading account is now worth $5,850. And we did this following our 5-step process we teach as part of our options paycheck system. So let me break this down a little bit. We took our paycheck system, which had already had a very simple, straightforward rule, but we simplified the process even more. So it only involves one ticker symbol. There's only one trade type. There's only one entry rule. There's only one profit rule, only one stop criteria. And these trades are a maximum of a 1-week duration. You saw in our examples from the last 5 weeks that these trades took anywhere from 2 hours to about 4 days. Now, we start with market direction. And market direction is very important because a lot of times traders just go out and they place trades all over. We could be in the biggest bull market of all time and we have people looking for selling opportunities. History, research, our own VectorVest research here has shown us that following the direction of the market will give you better probability. So what we do is we break the trades down by the DEW. So what you can see here is the DEW system here in VectorVest from September 24th to October 15th. When the DEW is down, we shade our trades bearish. When that DEW is up, like it turned on October 15th, we move our trades to the bullish side, and we simply use that DEW to tell us which direction to trade. Now, once you have market timing, the second step is stock selection. Now, what you need to do is narrow this down. But here's the thing. There are thousands of stocks to choose. You need to be able to narrow that down, and that can take a lot of time. Now, this is a great analogy, right? Look in somebody's closet. All they have is light gray pants and dark gray pants. They don't have to make a lot of choices here. All their outfits are pretty much the same. And if you've ever seen me in person, you'll probably know that I wear a lot of black shirts and khaki pants. Not because I don't want to put a lot of time into my wardrobe selection. I'm just a very simplistic person. I know that black goes with khaki and they go with my black shoes. And all my friends and family call that the Ron uniform. So I go through very simple in my selection as well. Now, when it comes to stocks, again, there's 1,000 plus, there's 8,000 stocks, there's 3,000 optionable stocks to choose from. And let me tell you, they all provide great trading opportunities, right? You're going to find some great stock trades that we can do. You could look through a list. You could use our VectorVest Unisearch to break it down even simpler. But let's make it even more efficient, because I like efficiency. I like to spend as little time as I can on trading and more time on things I love, like golf or hanging out with my kids. I want to make this as simple as possible. So instead of focusing on all of those, we're going to focus on one thing, just the SPX index, and that is it. You can be very efficient with your time, still very profitable if you just trade the SPX index. Now, there are a lot of benefits to trading the SPX index. First of all, one of the big things I get is, well, Ron, what about early assignment and all that kind of stuff? If you look at the biggest thing right there, it says cash settlement and European exercise. That means these options never become stock and they cannot be early assigned. They only get assigned after they expire. Another great thing is if you look in the lower right-hand corner, the 60-40 tax treatment. These capital gains may benefit for us here in the U.S., and I'm certainly not a tax advisor, so you would want to double check that with them. But these are taxed, as if you didn't know, they're called Section 1256 contracts. You can Google that. They are taxed at a 60-40 capital gains treatment. So it's very, very advantageous to trade these SPX options. Now again, instead of having dozens of trades, we're only going to use one symbol with one type of trade. That's it. There are hundreds of different option strategies that we could apply, but we don't need to see the best opportunities and how to make money here. So what I want to do is I want to show you how this trade is done and why we consider it what I like to call an income trade. Now, this is a screenshot from the S&P 500 back on Monday, actually, when we placed our last trade. If I would just go out and let's say I buy 100 shares of the SPY, or I buy an SPX call option because I think that the stock is going to go up or the market's going to go up. The problem is if you do that, the only way you make money is if the stock goes up. If it goes sideways, if it goes down, you will lose. We call that the buyer's mentality, that 50-50 hoping that a market or stock will go up. What we want you to do is switch to what we call the seller's mentality. We're going to use probability to select a price that says over the next week, the S&P should stay up above this price. And right as you see, it was right about 4,500 when the S&P was 4,566. So now what you're saying is, instead of I hope the stock goes up from here or the market goes up from here, now it's I hope it just stays over this price. It's kind of like getting a head start in a race, right? You ever look at a graph and say, man, that stock just ran 40 points. I wish I would have gotten into it 20 points ago. Same kind of idea here using the seller's mentality, okay? That's what we're looking to do. Think about that. We're picking a price below the current price of the S&P, and as long as the S&P stays above there, you can make money. So if we go up, we make money. If we go sideways, we can still make money. And if the market comes down, we can still make money. Now, if it goes below that 4,500 price in this case, we will take a small proportional loss. That's the beauty of this. Now, we call this again an income trade very simply because as a seller, you're putting the probability of success in your favor. That's why this is an income trade. Or more formally defined, it's one where you can make money even if you are wrong on direction. This trade, we are going to start with a 65% probability of winning. No more 50-50 propositions. A big reason why a lot of people fail is because they're only giving themselves a 50-50 shot. They fail because they aren't putting enough probability on their side. Now, I mentioned that this is going to be very, very simple, right? I want you to take a look at a lot of different option strategies, right? There's a wide variety of trades you could do. You could do butterflies and condors and straddles and strangles and puts and calls and married puts and put ratio back spreads and all that great stuff. We're going to take the options out of options, and we're simply going to focus on these two, the bull put spread and the bear call spread. That's it. And don't let the terms scare you. I'll show you examples in just a second, but think of it this way. Bull means the market's bullish and you want to place it when the market's rising. Put means you're going to use puts in the trade. A bear trade means it's bearish, right? And you want to place it when the market is falling. And calls mean you're going to use calls in the trade. So let's take a look. When you're bearish, we use a trade called a bear call credit spread. So when that DEW was down, we were doing the bear call credit spreads. When the DEW reversed, we started doing what's called a bull put credit spread. And if you look back in some of the strategies of the week, I've defined kind of a little bit more in depth on some of the bull puts and bear call trade processes that we've done in the past. Okay, so we're doing what's called a bull put and a bear call credit spread. Bull, bullish, put, puts. Credit means you receive a credit when you place the trade. In other words, you're receiving money instead of paying money. Spread simply means you're going to be using two different strike prices. Now, the next part of that setup procedure, that 5-step market approach, is trade setup. And again, instead of having dozens of trades to choose from, you want to be able to limit your choices here. And that's the beauty of this. So, it's not like buying a stock where the only thing you have to worry about is the price of the stock. With options, you have the price, but you also have things like strike prices and different expiration dates, which leaves you wondering, which ones do you pick? Because when you open your broker software, there are a lot of expirations to choose from, and there's lots of different reasons to use different expirations. So what we want to do is narrow this down by understanding this concept. We want to put time on your side. Now, one of the big things that we need to do is work into what's called options time decay. Okay? We're going to look at how option time decay happens. And what time decay simply is this. As an option gets closer and closer to expiration, the time value of it declines exponentially. It's kind of like if you go to the grocery store and see meat, right? If it expires today, it's a great value, only if you're going to go home and cook it that night. If you're going to let it rot in the freezer for 2 more days or 3 more days or 4 more days, you might as well just throw your money away. Options are very similar. What you see here is called a decay graph. And as you can see, I've got this 6 months out, way back here, right? What we are going to be doing is waiting till that option decay gets a lot more into its exponential decay. And that happens in this window right here. We're going to be selling in that window when option decay is in its highest exponential decay. And the reason why we do this is because this is what allows us to make money even if we are wrong on direction. A lot of mistakes that option buyers make revolve around option expiration. They'll buy an option with very few days left to expiration. They'll get the market right, but because this time decay is eating into the option, they still lose money. As a seller, this benefits us greatly. So we know we want to focus on those final 45 days of expiration. The next thing that we want to do is we want to pick a strike price. Strike prices are where you essentially control the market from. So I like to use this bowling analogy. Now, in bowling, right, we want to throw the ball down the middle, hopefully. Well, technically, you want to do it like between the 1 and 2 or the 1 and 3, depending on what hand you are. But we don't want to throw a gutter ball. But as an option seller, our goal is to throw a gutter ball. We don't actually want to hit the pins. So let me explain how this works, right? We want to get in our trades about a 65% probability. Remember this from earlier? We want to choose a strike price that has a little chance of getting hit. So the market's at 45.66. I do not want the market to hit 4,500. Now, it's very easy for somebody to come in here and say, well, Ron, why don't we just choose this price down here at 4,300? That's even farther away, right? Wouldn't that give us like 95%? Well, you have to have a balance of probability and then risk and reward. If you go way, way, way too far out, that's like one of those trades that you might have heard about where, hey, Ron, I had 30 winning trades in a row, but one trade came in and blew out all my profits, right? That's why we don't want to do that. We have to balance probability and risk, okay? We want to make sure we have enough room so we don't get whipsawed out, if you will, but then also close enough to where we don't have those catastrophic losses. All right? Because remember, we want to make enough room so we can be profitable if S&P goes up, sideways, or even down. That's the goal. Now, I placed into the trade or into the chart here something called a probability envelope. And what this does, it looks at the history of the S&P and gives a projection based on statistical analysis of where that stock or market should be in the future. So as you can see, what I'm essentially doing is selling or placing a price that's really over the next week outside of that channel. All right, remember, I'm only going to be in this trade for about 3 days on average, up to a week at the most. So I'm using the statistical probability and saying, I'm going to place a trade right here, and I should be out of the range of the market. Okay, that's really the idea. We're going to be trading at the edge of the range. So we're not going to be 6 lanes over in bowling. We're going to be in the gutter, but not 3 lanes apart from that. Way, way, way too much risk. That's the idea that we want from our income trades, that 65% built-in probability. Now, once we have the trade identified, we know we want to do, as a general sense, less than 45 days, strikes that have about 65% probability. We also have to manage the trade. Management consists of things like, where do I take profits? Where do I get stopped out? Things like that. And the one thing I want to focus on when it comes to taking profits is don't be greedy. I want you to manage the trade properly. I think of that game, Deal or No Deal. And, you get up to that $1 million, it's really, really ridiculously hard. Very few people win it. So why not just take profits at $75,000 instead of, hoping for $1 million when you know you're not going to win it based on statistics? That's the idea. Now, when it comes to these types of trades, what you can see here is a risk graph actually from the last trade we did this week, right? And what you're going to see is this is essentially where we took the trade. And as you can see, this risk graph is saying I have about 50% in profits, right? I sold the trade for $230. I have $115 in profit. And this is where I exit because the first 50% of the profits are the easiest. Look at how much time or look at how much price is required to get all full profits. The S&P would have to go up another 100 points. Where it only had to go up maybe 25 when it was all said and done to get that first 50%. You don't want to stay in the trade too long because the longer you stay in a trade, the more time when that trade can go against you. And if I look at that same trade, I think today on Friday, I think the market's actually down a little bit when I'm doing this class and we wouldn't be at the profit target again. So it's good that we take profits when we have those in place. Now, I mentioned earlier as a part of trade management, one of the things that we also want to consider is our risk. We don't want to take trades where one bad trade wipes out 30 or 40 gains. That's terrible. You can't make income that way. These trades are essentially 1-to-1. You are going to make about $150 on average for every winning trade, bulls and puts combined. And on the average, you're going to lose about $150 on a losing trade. So none of these one bad trade wipes out a bunch of winners. Okay? And the way we do that, number one, if you remember from that risk graph back, it might have shown you that, well, Ron, it had a $200 profit, but it had like a $600 or $700 maximum loss. We never take that maximum loss. We exit these trades at the short strike. Remember earlier I said if it goes below that price, we exit with a small proportional loss. So if I pick the price of 4,500 on the S&P, if the 4,500 price is hit, I can simply exit the trade. Now, what you just saw there was that 5-step approach. Market direction with the do. No more stock finder. We're just going to use the S&P. Option selection. We're going to do a bull put or a bear call. 65% probability on the strike. 45 days or less on the option. Trade setup. Trade management. Exit at 50% profits. Exit if it hits the short strike. You just got a good look at how that trade ultimately works. Now, I want to show you some results. Back in 2019, the system actually returned about 36% that year. Now, when you see these numbers over here, that 2,000, 1,800, remember, that represents one contract with a $5,000 account. Now, just to show you, over the last about 8-9 months, or actually, if you go to 2020, the system performed very well in 2020. We had a little bit of a setback with some drawdown here in late 2020. And then since that, it's only been up about 5 or 6%. Now, the last 17% that we just made has really pushed that trade back in. Instead of sitting here back where we're only up about $1,600, we can add another $800 in profits, and we've actually made a lot more here in the last month and a half that we've been doing this. So I want you to understand that it's not all winning trades. You're going to have some losers here and there. Like any trading system, there may be a little bit of sideways activity. But let's compare what this system has done over the last few years to the S&P. Now, since 2019, the S&P has been up 40%, okay? And the biggest problem that we had in the S&P was last year during the coronavirus. You had to sit through some serious drawdown. So the S&P looked like this. Now, when you match that to our income approach, that's how it worked in 2019, and then 2020 on. And again, I have the last 6-7 weeks of the trading system outlined. You saw the 5 trades that we did prior to that where we made 17%. Now we're actually over that high. So even though we had a little bit of period where the market or the system didn't return as well, if you look at that over the long haul, the S&P is up 40%. Before those last 5 winning trades, this system was up 69%. Now it's most likely over 73 or 74%. So even in those times, the system outperforms the S&P, and that's the beauty. Now, what you just saw was an introduction to our income for the SPX. The best way to learn this system is to register for our course called the Options Paycheck, 7 weeks to income. It's part of that course, and registration is currently open. So if you want to hear more about it, stick around for a few minutes and I'll tell you about it. It's designed to take you step by step through the system to generate safe, consistent income. And it's going to teach you everything, what you'll see here in just a few minutes. Now, before I get to the nitty-gritty, I also want you to understand it comes with a 100% money-back guarantee. If after the course is over, you don't believe that I've taught you a good income system, we'll give you your money back. The only thing I need from you is a commitment to go through the education, watch the videos, do some of the assignments, and then if you do that and still are not satisfied, I'll give you your money back. Simple as that. I mentioned that we're opening enrollment now. The 7 weeks of the paycheck, it starts next week live. But if you can't view it live, it's not a big deal. We do everything via recording as well. So if you can't view our live recordings, we do everything with a recording. So you'll be able to access all of that as we go through the course week by week. We're going to start building the option foundation in week 1, teaching you to understand how calls and puts work so you can use them right. Modules 2 and 3 are about teaching you trades that are bullish, bearish, and neutral. We just talked about bullish and bearish today. We're also going to show you neutral. Module 4 is where we're going to introduce how to find stocks. So the income system's a great start on the S&P, but we're going to extrapolate that out to finding stocks to trade as well, because they can double the amount of income you make when you start applying it to stocks as well. That's Module 4, and we'll also introduce indexes in that section. Module 5 is about making sure you're getting paid the proper amount, understanding risk reward. Module 6, we talk about where to exit, where to take a loss, how to adjust the trade. We also talk about portfolio management. How much should you risk? How many contracts should you trade? And then Module 7 talks more about the brokerage side. We can't teach you how to trade with every brokerage, but we can at least show you the terms and things to look for. Now, that's a 7-week live course. We also have it via recording too, so you don't have to attend live. About a $1,900 value. Now, if you're worried, Ron, how much options experience do I really need to do this? It looks pretty intense, right? We polled our prior attendees, and 83% of them said that you can be successful with this with little to no prior options experience. So you can do it. Now, I'm also going to throw in some bonuses. Number 1 is the SPX paycheck. That's the snippet that you just saw tonight. How to do that trade on one trade type with one ticker symbol, one setup rule, etc. We just finished an income challenge teaching this, and we saw a post in our Facebook forum from Kathy. Just closed that 44.25, 44.35 bear call spread. That was back from October 13th, probably matched my trade because we did it all together. One of our other clients was trading it a little more actively. Alan was trading it multiple times per week, and he said he made over $5,500 and the week wasn't over. We'll also include 7 live mastery support sessions. Here at VectorVest, we're very important part of what we do is implementation. We want you to implement what we teach. So every week we're going to have a live course, and again, it's recorded, so if you can't see it, it's no big deal, where we are going to implement the processes we learn week to week. That's going to be 7 of those. There's also a Facebook community that we open up. If you want to join the community, you can ask questions there, interact with our team. It's a nice community for people going through the course. We also do 12 months of live Q&A. If you do not currently have either VectorVest or Options Pro, we're going to give that to you. And that's the software that we use to find and set up our option trades, mainly for stocks. You'll get access to that when the class starts. I'm also going to give you 7 weeks access to my members-only group coaching. I went a little bit out of order there. Sometimes live presentations like this do that. I'm going to give you access to that. Every week, I have clients that I take through and show how to find and implement these trades. I'm going to give you access to that as well. Okay? And if you're new to Options Foundation course. If you are still a little bit worried that you might not be able to handle it, we have an Options Foundation course you can go through before the live session even starts and learn some of the basics. So let me kind of sum up the package. Options Paycheck course, SPX Paycheck bonus, Mastery support sessions, weekly coaching and trade recommendations, access to both the VectorVest and Options Pro software if you currently do not have it, our Facebook group with 12 months of Q&A, and our Options Foundation course. That total value is $6,856, but I want to make you a special offer today. Give me 7 weeks. I'm going to roll up my sleeves. I'm going to work with a few hundred investors, and I'm going to teach you how to do this even if you've never had success with options. So if you are interested in the entire Options Paycheck package, I want you to go to www.optionspaycheck.com, click on the big orange register button. It's $9.95. It's a very special price, and I would look forward to seeing you there. So again, www.optionspaycheck.com. You can go $9.95. So sign up today. Registration is open right now for the course that starts next week. This is a great time to learn an income system that you can apply in 2022. Thank you for your attendance tonight. I appreciate it. Have a great rest of your year and best of success in investing. Thanks again, everyone.
Yeah.